Mortgage rates, are they finally going to drop? Will home prices continue to climb even if the economy slows down? What about all those dire predictions of a housing crash? Have they just been noise for all these years? In 2025, the Fed is expected to cut interest rates, but I'm here to tell you they might go much lower than anyone thinks. I'm talking about the possibility of mortgage rates dipping back into the 5% range. Yes, again, 5%. So do you think that will shake up the market? Absolutely. If we see interest rates at 5%, we will absolutely see more demand. While everybody's focused on rates, the real story is still the housing supply. We're short millions of homes. And with the Millennials and Gen Z gearing up to buy, is this really a bubble waiting to burst? It's a market getting ready to explode higher. And what about inflation? It's not what it seemed. Core numbers are finally coming down and the Fed's hand might be forced sooner than they like. What happens when inflation cools faster than expected? The bond market rallies, mortgage rates fall, and buyers who've been waiting on the sidelines jump back in with both feet. The 2025 forecast for interest rates, inflation, the housing market, and everything in between. I'm going to uncover the trends, the surprises, and how all this will shape the real estate market this year, 2025. Let's start with the Fed's plan for interest rates. At the end of last year, the Fed projected they lower rates gradually in 2025. Their December dot plot shows a median forecast for 2 rate cuts, bringing the federal funds rate from its current level of 4 3/8 to 3 7/8. This is a change from previous dot plot predictions of more cuts. But here's the kicker. I believe the Fed might cut even deeper, down to 3 3/8. That's 2 additional more cuts, and more in line with the previous dot plot. And why? Why do I have this prediction? It all hinges on the labor market and inflation. Right now, the unemployment rate is at 4.2%, but as we look ahead, it's expected to rise to 4.5 or even 4.6. Now, that may not sound like a huge jump, but it's enough to shock the Fed. If unemployment hits 4.6%, every single Fed member would have to reconsider their stance. The chart shows exactly where they expect unemployment to be, and 4.6 would be above that. That's where I see more opportunities for aggressive rate cuts. Now, let's talk a little bit about inflation. As of late 2024, core PCE inflation was sitting at 2.8%, still above the Fed's target of 2%. But here's something most people don't realize. That number is likely overstated. Shelter, which makes up 18% of core PCE, is reported as increasing by 4.8% year over year. But according to the real-world data from CoreLogic, rents are only rising at 1.7. That's 3.1% overstatement, inflates the core PCE by about a half a percentage point. Adjusted for this, core PCE should already be closer to 2.3%. The good news, shelter data is finally catching up. As outdated numbers are replaced with current readings, inflation will trend downward. By year's end, we project core PCE will fall to 2.1 to 2.2, giving the Fed even more room to cut rates. Let's shift our focus to the labor markets, where the cracks are starting to show. Unemployment isn't just rising, it's lasting longer. Over the past 7 months, the median duration of unemployment has jumped by 21%. You hear it in the media headlines all the time. Look at the actual store closings in 2024. Those are actual jobs being lost, which flows right into job openings. They've fallen significantly from 8.8 million a year ago to just 7.7 million now. But even that number may be overstated as well. The Wall Street Journal just wrote about this in mid-January. With so many remote jobs, companies often post the same role in multiple states, inflating the data. The real number of job openings could be closer to 6 million or even lower. All of this points to a softer labor market in 2025, which will likely push the Fed to have to act faster on those rate cuts. Now, this is what everybody wants to hear about. Let's talk about mortgage rates and where they're headed. I'm forecasting that the 10-year Treasury yields will drop to 3.6% or even lower this year. This is due to what we spoke about earlier, tougher labor markets, lower and slower inflation. The spread between the 10-year Treasury and the 30-year fixed mortgage rates typically ranges around 1.6 to 2%. It has been abnormally high, and it's also expected to narrow. You can see it in the chart below. In October of 2023, the spread was 3.1%, leading to the 30-year mortgage rates above 7%. Today, the spread is closer to 2.5%. If it narrows further to 2.25% and the Treasury yields hit 3.6%, we could see mortgage rates drop to around 5.8%. Again, take a look at the charts below. I'm not alone on this. There are 17 other forecasts that predict interest rates will drop over the next year. The average around 6.33%, so I'm a little bit lower than what the 17 others are averaging right now. For buyers, this means more affordability and more opportunity in 2025. So keep your head up. Help is on the way. Now let's shift our focus to demographics. The numbers for millennials and Gen Z are game-changing. Millennials, the largest generation at 73 million, are entering their prime home buying years. Currently, 45% own homes, but among younger millennials, aged 30 or below, the homeownership rate is just at 33%. Over the next decade, that number is projected to rise to 55%, adding another 8.5 million new homeowners. Gen Z, with a median age of 20, is just beginning their homeownership journey. Their current rate sits at 8%, but by the time they reach 30, it's expected to climb to 33%, adding another 17 million homeowners. Together, 25 million new homeowners in the next decade. Demand is building, and the housing market is ready to respond. Active listings are up 27% year over year, but here's the bigger picture. Compared to 2018, we're still 21% below normal levels. And even though the population has grown by 12 million since then, so again, significant shortage. The persistent inventory shortage is a major factor keeping home prices stable, even as interest rates have risen. With household formations averaging 1.9 million per year, but starts trailing at just 1.3, demand continues to outpace supply. So what does this mean for home prices? In 2025, I expect annual appreciation to be between 4% and 4.5%. For a $500,000 home, that's a gain of around $20,000 in just 1 year. Looking further ahead, the 5-year cumulative approach could reach 30 to 35%. That's 150 to 175% of equity for a $500,000 purchase today. Even with interest rates rising, the fundamentals of supply and demand remain strong. To sum it all up, 2025 is shaping up to be a pivotal year for the economy and for real estate. We're looking at the federal funds rate dropping to as low as 3.375%, core PCE inflation falling to 2.1 to 2.2, mortgage rates declining to 5.75 to 6%, and the housing market to continue to grow with prices appreciating at 4 to 4.5% annually. If you're thinking about buying, selling, or investing, 2025 could be the year for you. If you've been sitting on the sidelines for the last 4 or 5 years, it's time to get off and stop watching the appreciation fly by. As always, I'm here to guide you through it. Thanks for watching, and don't forget to like, subscribe, and share this video with someone who needs to hear this forecast. Until next time, I'm Darin Hunter, and I'm hunting down the best opportunities in real estate for you, and that, my friends, is guaranteed.